happening this year. Am I loud enough for those of you who are hiding in the back? TCJA, Tax Cuts and Jobs Act. As far as I know, all the provisions in the law definitely deal with tax cuts. I don't think there's a provision in the law that has to do anything with actual creation of jobs, but it's supposed to be an after effect. Some of you in the room know me, most of you don't. My name is Bob Askey. I'm part of Askey and Associates. I'm the second Askey in this. I'm a partner with my wife, Kathy. We started the firm here in Leonardtown in 1996 and have been here in the same spot ever since. We have an office also in Plata that we opened up in 2006. I graduated from Towson State College in the last century. And shortly after that, I went to work for the IRS. I was agent for 3.5 years, auditing personal taxes and corporate taxes in Washington, D.C., metropolitan area, and also across the country for 1.5 years. And after doing that for 3.5 years, I realized it was probably time to leave the dark side and come over to the light side of the force. And I've been fighting IRS ever since. It provides a unique perspective, knowing how they're trained and how they think. And other than in a couple of situations over all that time, it's worked fairly well until you come up against a very poorly trained and unreasonable agent, and then that's always fun. With me today are 3 of our team members, Monica, Erica, and Aaron. Monica and Erica will be doing similar presentations, so they wanted to see how not to do it, so they came here today. Before I get going, just to wake you up, because I know tax law isn't something that people really like to. Aaron's gone, but point up here, or see, I didn't practice on this, so let's see. There we go. You can't read that. I'm a little worried about my new tax software. It's recommended I slip across the border into Canada. Here. This one I like even better because you see it's AAA tax prep, so Askey and Associates, and I did not make this. I just found it. You rob from the rich and give to the poor, but you don't get any tax receipts? Come on. You've never heard your accountant say that, have you? I did want to give you a little bit of perspective of tax law in the United States. Tax law began, and I know you can't see it, 1918. We don't have 2018 here yet, but in that span of time, here's your 50% mark. This is the top tax rates in this country over this period of time. 90%, 1948. So after World War II, the highest tax rate in this country, 90%. And we probably hear it more than anybody else, clients complaining about how high the tax rates are. And just think about how, I know my parents felt back in that period of time. And now, we're at less than 40% at a top tax rate with our current tax law. So, with the Tax Cut and Jobs Act, we initially, prior to this new law, we had 7 different tax brackets. We still have 7 different tax brackets, but the lowest bracket went down and the highest bracket went down. So we start out at 10% at the very lowest and end up maximum at 37%. And I only show single in these categories because the joint tax brackets, if you will, are essentially double what the single rate is until you get down to the maximum tax bracket. And the married filing joint hits 37% over $600,000 of taxable income. Thank you, Randy. This is where the water comes in, because the more I talk, the drier I get. One of the nice things that happened on the new tax law is that the child tax credit was doubled. It used to be $1,000, now it's $2,000 per qualified child. And the phase out I want to say the single phase out started at around $70,000, so the credit is going to apply to many more taxpayers than it had in the past. And the joint rate, in a lot of these cases, they just automatically double from single to joint where the phase outs occur. Education credits, initially when the House and Senate were talking about making these changes, they were going to cut the credits. But as it turned out, the credits survived. They're essentially in the same format that they were prior to this law. So your Hope Scholarship or your American Opportunity Tax Credit, $2,500 maximum, and the Lifetime Learning Credit are still at the same rates that they were at before. Remember that higher incomes, we also have these phasing out. So higher income families will not be able to take advantage of this credit. It's lower to middle income families that will benefit by the education credits. I didn't mention when I started out, this is about 20-25 minute presentation, and I tend to talk fast. If you have any questions, I'm happy to answer them, but if you can hold them to the end, I'll answer every question that you have. And if I don't know the answer, I'll make it up, or I'll have Monica, Erica, or Aaron look up on Google what the correct answer is. Personal exemptions are gone, at least, not gone, suspended. I love the way the Congress uses terminology because if they repeal something, that means it goes away. When they suspend it, it means it's probably coming back someday. But for now, we have no more personal exemptions for ourselves or our dependents, so they're irrelevant at this point. Haven't you always wanted to say your kids are irrelevant? The standard deduction almost doubles from what it was before, and this is largely because what we'll go through in a minute is there are a lot of itemized deductions that have changed dramatically. So they made it easy for themselves because most of the members in Congress are not accountants, so they don't want to mix the numbers up real heavily. So you'll notice it's 12, 24, 12, 18, 6,000 increments between the different categories. So it's pretty easy to remember. More and more people are going to be using the standard deduction now as a result of this new tax law. Medical expenses, initially there was some question of whether or not they were going to just toss medical expenses out the door completely. Again, they decided in conference that they'd leave the medical expense deduction in as an itemized deduction. And in addition, they decided to change it. It was 10% of adjusted gross income, so your medical expenses had to exceed 10% of your adjusted gross income before you got the first dollar of deduction. They dropped that to 7.5%, and now they're talking about making that change permanent. I'm sure everyone's heard of SALT, state and local income tax. In the state of Maryland, particularly the state of New York, state of New Jersey, those three states, I believe, are the three that have filed suit against the federal government because of this new tax law. Many of the taxpayers in this state will lose an awful lot of deductions because the state income tax is limited to $10,000. And that's just not just income tax, it's all local tax. Real estate tax, personal property tax for states like Virginia, and sales taxes. Now this is Schedule A, personal itemized deductions. This does not apply to businesses and any taxes that the businesses pay, such as corporations. They're still going to get a deduction for the taxes paid. The big change in the deduction of residential mortgage interest, under old law, the limit was you could deduct interest on debt up to $1 million on your principal and your secondary residence. And you could have a home equity loan of up to $100,000. So you could effectively deduct interest on debt up to $1.1 million for two residences. So Congress decided they're going to drop it to $750,000 for a joint return. $375,000 this is the debt amount now, not the deduction, for married filing separate. For any post 12/15/2017 acquisition indebtedness. Acquisition indebtedness basically is defined as money borrowed to purchase a new home or money borrowed to improve or otherwise enhance a new home. The money is placed into the residence, up to $750,000. Home equity debt is gone, suspended, again, suspended entirely. Now what that means, if you have a home equity loan in place at the end of 17, that interest is still deductible, but if you draw money on a new home equity loan after 12/15/17, that interest is not deductible on either the first or the second home. Never was on the second, only on the first. If you itemize your return in the past on your Schedule A, the bottom, the miscellaneous itemized deductions, gone entirely. That includes, unfortunately, tax prep fees, investment fees, any employee business expenses. That's the catch-all category at the bottom of the Schedule A. No more. They're gone. Excuse me, I should say suspended. Charity made out reasonably well. They have a great lobby. We're now at 60% of adjusted gross income, whereas for a very long time, we've been limited to 50% of adjusted gross income on charitable contribution deductions. So for 2018 and beyond, we're going to be at 60% of adjusted gross income for those who are very charitable giving. You can give very significant amounts and get a current deduction for it. Anything that is not, you can't deduct currently because it's over the 60% would be carried forward to a later year. And there are some more significant limitations with respect to the deduction of vehicles. Basically, if you donate a vehicle to, say, Melwood or someone like that, they're basically going to have to sell the car and get a real value before you can find out what your deduction is going to be, because there was so much abuse in that area in years past.
So now, if you donated and they sent you, because I donated to a group and they sent me a thing and said, here's how much we sold your vehicle
Yes.
for, you can deduct that.
Mm-hmm. 401ks, what I like to refer to is the last legal tax shelter in the code. We basically will tell everybody, to the extent that you can shift taxable wages, taxable compensation to a 401k, you're not going to be taxed currently on it. There are no tax shelters that can convert wages to make them non-deductible. They're always going to be taxed, except for this deferral. Under age 50, for those of you who are like me who are under 50, we can only deduct $18,500. For those who are over 50, you can deduct another $6,000, contribute and deduct another $6,000 for a total of $24,500 in 2018. And I encourage everybody, and I know my investment people will say the same thing, put as much away as possible for the future, whether it's in a taxable 401k or a Roth 401k. Get it out of, well, Roth won't come out of current income, but it'll defer down the road. Roth 401ks work the same as Roth IRAs. Basically, the contributions to the Roth come from after-tax dollars. So you've already paid tax on it, you're putting the balance in the Roth, and the income, the account grows tax-free over time, and then distributions down the road are not taxable. Roth IRAs, same thing as the Roth 401k in that the contributions are non-deductible, but they'll grow tax-free and you'll receive tax-free distributions down the road if they're qualified distributions. Basically, the money's got to stay in there for 5 years at least, at a certain age, and tax-free distributions down the road. Now, you do have income limits with respect to the Roth contributions, and these, I'm pretty sure I changed these to the 2018 limitations. So if you're over that, level in income, you are prohibited from making a Roth contribution, Roth IRA contribution for the current year, okay? So there's an alternative that planners have come up with, that basically what you do is you make a contribution, instead of making it to the Roth IRA, you make the contribution to a traditional, non-deductible IRA, and then before the due date of the tax return for that year, convert that traditional IRA to a Roth IRA. And that's what we refer to as a backdoor Roth contribution. It's a great deal because you get it, you couldn't deduct it anyway in the traditional because you're over the limit. But the income limits prevented you from doing a Roth, so you make the traditional, next year you move it over to the Roth and you're right where you want it to be. Now, the hazard of this is if you have any other traditional IRAs than that one you just set up, you have a problem. Because any distribution from any IRA account is treated as if it was a distribution that was made proportionately from all of your IRA accounts. So if you had an IRA account with $300,000 in it and it was a taxable IRA account, and you did this little maneuver, you put $6,000 into a traditional IRA and then next year converted it to a Roth, and you have this $6,000 IRA here and this $300,000 IRA here, well, most of that shift from that $6,000 IRA to the Roth actually came from this $300,000, so it becomes taxable. Be careful if you have multiple IRAs and you try to do this.
What if you're taking a required minimum distribution? Is there a way to take that and turn it into a Roth?
No. No, if you're taking an RMD, you're going to pay tax on one way or the other, and they're limited.
You can't take that and then reinvest it back into a Roth.
I don't believe so. Not if you're at the point where you're required to take a minimum distribution. I think they're currently talking about changing the rule as to there's an age limitation when you can make the contribution.
Yeah.
So if you're taking the minimum distribution, you may be prohibited currently. But I think they're talking about the possibility of changing it. IRA accounts can be used for purchase of a first home and for college expenses, but the trap that people fall into on this is thinking, okay, I can use this for my first home. It's not taxable. Well, that's not true. It is taxable when you draw it out of the IRA. You just don't have to pay the penalty of 10%. So you're saving that 10% on it, but you are going to pay tax on the actual distribution. So the big question is, what's better, a Roth or a traditional IRA? And depending on who you talk to, when you talk to them, you'll get different answers of what's better for you. Typically, my viewpoint is that if you have someone, like with my kids, they're 23 and 26, I'm telling them to do Roths because they're in very low tax brackets. So they're able to put the money away. They're not going to get a big deduction. They're not going to have a big tax savings by putting money into a traditional. So they can put the money into a Roth that can grow and then come out when years down the road when they reach retirement age and it's tax-free. If you have someone who's in, say, in their mid-40s or 50s and they're in a very high tax bracket, it may be more advantageous to contribute to a traditional IRA because you're going to get the tax savings, with the theory being if I'm in a very high tax bracket today, when I retire and at age 70 and a half, I start taking that out, I'm going to be in a much lower tax bracket. That's the logic behind it. So you just kind of have to look at each individual situation to see which one might apply to you. Capital gains and dividends. The big thing here is that capital gains and dividends are taxed differently. There's a standard rate that everybody refers to, the 15% capital gains rate. Okay, so the 15% capital gains rate applies to the middle income tax brackets, and when you're in the lowest tax brackets, you can have a capital gain as long as you're in the low tax bracket, you pay zero tax. If you're in the highest tax bracket of 37%, you're now going to pay 20% on your capital gains and dividend income. There's two different kinds of capital gains. You have short-term capital gains and long-term capital gains. The difference between the two is simply the time you've held the investment. It has to be long-term, it has to be more than 12 months. So short-term capital gains are just taxed as ordinary income. They can be taxed at 37% if you're in that bracket. As an example, someone holds an asset for 11 months, an investment, sells it for $50,000, pays tax of $17,500, they net out $32,500. Okay? They sold it because they knew it was at its peak. It could go down another $10,000, sell it after 12 months, and they still come out ahead just having held that asset for another month. So the whole idea is don't rush to judgment and sell something quickly. Think, if you can hold it for 12 months, you're going to get a break. If there's a gain there. If it's a loss, it's not going to matter. Large capital gains can trigger AMT, alternative minimum tax. I don't know how many are familiar with alternative minimum tax, but it has been affecting more and more people over the years. There are a number of different things that can trigger or at least add to the problem of alternative minimum tax. Large capital gains, numerous, oh, well, no, they're gone, forget that. State income tax, that's not going to pitch anymore, and the itemized deductions aren't going to have any effect because you can't deduct them anymore. So there's really not that many things that are going to trigger alternative minimum tax in 2018 and beyond. And in addition to this, the exemptions for individual alternative minimum tax have increased substantially. So we will, in all likelihood, see a drop of those who are paying alternative minimum tax by probably 60 or 70%. A tip for the investment people. What people don't think of is a lot of times in the mutual funds they kick off large gains. And we get taxed on them, money that might not necessarily come out of the mutual fund. And so why am I paying tax on this? One of the things that people forget about is to look at what they have. And if you have a loser in your portfolio, don't hold on to it. If you don't have any prospect for it for the future, sell your losses to protect those gains. Different thought process with respect to how to invest. Do you put your money in the bank and earn ordinary interest income, which is taxed at the highest rate? Or do you invest in corporate stocks, which are paying dividends and are taxed at 15%? If you invest in somewhere in a mutual fund or in a corporation that you know is going to pay certain dividends, and you go pay 15% tax, and it's the same rate you could get investing and putting the money in a bank account and earning 0.1% or whatever they're paying now, I'm not sure, but whatever interest that they pay is going to get taxed at ordinary rates. Okay, so you have to shift your mentality a little bit as far as how you're going to invest, not really taking into consideration that the tax laws might change and reverse that, who knows, but for the tax law right now, that's what we have to work with. Personal casualty and theft losses were always deductible in the past. Not anymore. The theory, I think, was that you should be insured, make sure you pay insurance, and then you don't need a income tax benefit as a result of having that loss. And alimony will no longer be deductible after this year, 2018. Alimony will no longer be income after 2018. So if you're thinking about getting a divorce, you might want to hurry up. Actually, as long as I've been doing this, this is one provision that I've really never understood in the tax code because it is one of the most contentious items in a divorce settlement. Trying to work things out between a husband and wife in a divorce arrangement. Personally, I'm kind of glad it's gone, or will be gone after this year. Moving expense. If you move for a job, you always deducted in the past. Not anymore. Correspondingly, an employer's reimbursement to you for moving will no longer be tax-free. You'll be taxed on it. So if your employer moves you to San Diego and says, I'll pay your freight, that's going to show up in your W-2. No more deduction for it. 529 plans can now be used up to $10,000 for qualified elementary and high school. So this is a very important change that's going to affect, it's going to benefit a lot of people that have the 529 plan set up. The best thing with a 529 plan is to invest it as heavily as you can early on while the kids are really young, and then there may be enough in there for the college tuition when they get to that point. Businesses, we have a new thing in the code for businesses, never been there before. Basically, it's a 20% deduction. It's called for pass-through businesses. Partnerships, S corporations also applies to sole proprietorship, Schedule C. I say it's 20% sort of because it's a very convoluted calculation. Trying to get Monica to take as many courses on it so she becomes our expert in this. So if you have questions about how this is calculated, we really don't have an answer yet, but we're getting there. But basically, it's 20% of your net income is probably the best way to think of it. And it applies to most businesses, pass-through businesses. However, service businesses, or what they call SSTBs, I won't say what it sounds like, it's special service trades or businesses is what the SSTB means. These are severely limited in what they may or may not be able to deduct via this 20% rule. Basically, the service business who's in a very high income bracket probably is not going to receive any benefit from this particular provision. But for whatever reason, if you're an engineer or an architect, the SSTB rule won't apply to you, so you're okay. How that got in there, I don't know. I would have expected lawyers, but it wasn't. Section 179 of the code allows businesses to deduct purchases of equipment, expense them in the current year, expense them in the year of purchase, okay? It's now for new or used property. You can elect Section 179, and for 2018, you can deduct $1 million. Now, you do have to purchase $1 million worth of equipment, but then you can deduct that all in 1 year, okay? Unless your purchases exceed 2.5 mil, and then you're limited. In addition to that, we have a provision now in the code that says you can take bonus depreciation of 100% of the cost of certain equipment, certain property. And this is for purchases between 9/27/17 and 2023. And then it gets phased out. So I have two provisions basically in the code that tell me I can do the same thing, it sounds like, right? There's a slight difference in them because the bonus depreciation you can take even if it creates a loss. So if you're borderline, you want to create an NOL, net operating loss, you can take your bonus depreciation and create a big loss and carry it forward. It might be advantageous to do this if you expect a lot of a very high level of income in the following year, because then it will all be absorbed in 1 year or 2 years instead of the life of the asset. Section 179 can't be used to create a loss. That's the big difference in the two. At least it's the biggest difference that I've been able to think of. There are, for certain types of property, for business property, real estate, typically we've been depreciating business property over 39 years. But for qualified property, and unfortunately I don't have on the tip of my tongue, I know restaurant property, we can elect to depreciate those over 15 years instead of 39. That's a big benefit for these types of properties.